Welcome everybody to the next in our series of events covering options for your ISA. I think it's fair to say that the last year or two, European equities have been having a moment, and one of the other features is that the headline index has performed extremely well, but it's split quite dramatically, different active fund managers, and one of the investment trusts that finds itself on the right side of that split, very solidly indeed, is JPMorgan European Growth and Income. So really pleased to have one of the management team, Tim Lewis, who's going to talk about the trust and talk about the outlook for Europe. And we can discuss the dividend policy and all the other features of the trust as well. Before I do that, just very briefly, some housekeeping. Many of you will already know this, but there's a Q&A box in the bottom right-hand corner of your screen. Please type questions in there as the presentation is going on. I'll be moderating those. And feel free to ask any technical support questions as well. Somebody will try and help you if you've got any issues. Tim will talk for about 20-25 minutes, and then we'll have another 15 or 20 minutes after that for questions. So with that, Tim, I'll hand over to you.
Great. Thanks, Alan. Good afternoon, everyone. And thanks for joining us to talk about JPMorgan Europe Growth and Income, or JEGI as it's known for short. So I'm Tim Lewis. I'm one of the portfolio managers, as Alan mentioned, working alongside Alexander and Zaina, who you see on this slide. So I think before we really get stuck into it, it makes sense to lay out at a high level what exactly JEGI offers to investors and why we think this might be interesting for your ISA. So, firstly, ultimately, what we are trying to achieve from this portfolio is consistent and risk-controlled alpha generation from a diversified group of European companies, excluding those listed in the UK. So if you're already content with your domestic UK allocation that you have, this is a real complement to sit alongside it. It's a portfolio that's balanced and we believe can outperform in different market cycles and conditions. So it isn't dependent on a certain sector or style to perform, whether it's value or growth stocks leading the market. If it's more cyclical market or more defensive, we think we can perform through all of those market environments. And we think that is reflected in the performance chart that you see on the right-hand side of this slide. So, this has been a time where we've experienced a number of those cycles, real changing market leadership in terms of styles, and we've managed to have that consistent outperformance throughout. Secondly, to do this, we adopt a differentiated and disciplined investment process. And again, we think that this is a slightly different investment process that is a real complement to what people have in portfolios already. It's one that enhances the best of the resources we have at JPMorgan, both on a quantitative side and also from the fundamental research done. And I'll move further on through this presentation to discuss that. And then finally, and very importantly, the portfolio adopts an enhanced income policy. And so that means we pay a 4% yield based off the NAV at the start of the year and paid quarterly. Now, importantly for us, that yield comes from the income we receive in the portfolio, from our reserves, and from capital if required, which means that as shareholders, you can get this attractive and well-flagged dividend yield without us as portfolio managers having to compromise at all in the sort of stocks that we're selecting. So let's go through to talk about our investment approach. And usually at this point, having said how we have a very differentiated investment process, I begin with our investment philosophy at the tagline at the top that says, we believe that attractively valued, high-quality stocks with positive momentum outperform the market. And the first reaction is probably that doesn't sound very differentiated at all, which would be fair, because I think that's what most portfolio managers should be looking for. Where I think we do differ is the discipline that we use to find those stocks and the tools that we use to find them, And then secondly, in how we define some of this view. So if we start with, is it a good business? You know, we want to invest in quality businesses. That's companies that are generating good and sustainable returns on invested capital. Companies with high profit margins and good pricing powers. Companies that are generating, you know, where their earnings per share is translating into free cash flow. And we want to invest behind management teams that, you know, fundamentally are making good capital allocation decisions with the capital that we give to them. But it's very important for us that that doesn't lead us to being completely focused on the best quality companies in the universe, because it's still very important to be disciplined in terms of the valuation. So we have to work out when the market has already discounted these prospects for the you know, or whether the opportunity is still there to make money. It's very easy to identify the best quality companies in Europe. What we need to be doing is looking forward to seeing where are companies improving or getting worse in terms of their quality, or where is the market fundamentally mispricing these opportunities. And lastly, in terms of momentum, it's really important that the company's operational momentum is improving. And so the most important way that we would look at this is by looking at management guidance or looking at earnings per share revisions that are coming out of the sell side to see whether these are being upgraded or downgraded over time. But I think, and talking about some of those resources we have at JPMorgan, it's been great to see the evolution of some of these signals, you know, where we're using more machine learning and more AI tools to really enhance our process in a way that is still consistent with what we've always looked for. I think it's important to stop here and say that not all the companies that we invest in will have all these attributes, but overall, the portfolio as a whole will be cheaper than the market, will have better quality characteristics than the market, and will have better momentum than the overall market. So I've spoken a bit about that differentiated process. So what does that mean? Well, so our process combines both quantitative and fundamental analysis. And as portfolio managers, as I say, what we're looking to do is extract as much as possible from the capabilities that we have here. So on the quantitative side, those tools allow us to assess over 1,000 companies daily in a rigorous and repeatable way. That breadth of analysis is hugely important for us in coming up with new ideas and fresh ideas into the portfolio. But it's the other fundamental importance of that is that it's objective and unemotional. So that allows us to put a lens on both what we own and what we maybe want to avoid, to highlight where there are good opportunities, maybe stocks that, despite being a turbulent decade, are now screening as really cheap with improving quality, or maybe a stock that's been a great performer for you, but the valuation just doesn't stack up anymore. Those quantitative tools really help us to focus in our attention on that. But that's what they do. They focus our attention to then allow us to add the fundamental analysis on top of that. And so that comes from the 3 portfolio managers that you saw on the first slide, and also the wider team of portfolio managers that support us. It also comes from sell-side research that's out there. We are always talking to sell-side analysts to understand their view, but also what the market narrative is. And then we're also very lucky within JPMorgan to have a proprietary group of sector specialist analysts that are focused on the medium and long term for these companies, which are helping us to develop deeper stock-specific insights, to be more forward-looking, more context-aware, and to kind of think beyond purely those quantitative numbers. And then ultimately, what we need to do is to bring these ideas together to form a portfolio which balances our stock insight with appropriate risk management. And usually when people think about risk management, it's almost like a defensive thing. For us, it's the opposite. We really believe in our ability to add alpha through stock selection. So what we don't want to have is to have unintended macro or style risks in our portfolio that we don't want there, and that might dilute the returns that we're getting at a stock level. So here we're combining both proprietary tools and external tools to view our portfolio from multiple perspectives, to run scenario analysis to help us manage risk, And we keep tight stock and sector constraints because we're comfortable that our process is identifying lots of opportunities for us, and we can have still be differentiated at a stock level and have multiple alpha opportunities for us within that. Usually, having said all that, the easiest way to describe this to people is by giving a stock example, and the one I always like to start with is UniCredit. Predominantly because over almost any time period, this has been certainly 1, 3, and 5 years, this has been the biggest contributor to relative performance in the portfolio, but also because it's the most controversial probably when we start off by saying, is this a good business? We're looking to invest behind quality businesses, and we start by pointing you to an Italian bank. And maybe that's not the case now, but it certainly was in 2022 when we were making this investment. So what was it that we looked at in UniCredit then, and what do we still see today? So firstly, when we were looking at UniCredit in early 2022, we were seeing the heavy lifting that had been done by the previous CEO, Mustier, in cleaning up the loan book. And now we were starting to see basically an improving loan book under the hood. On top of that, we had a very regulated sector, which had really been hammered for the past decade, meaning that capital was at high levels. And we were starting to see then, with more normalized rate environment, vastly improved profitability coming through in the business. On top of that, the new management team led by Rochelle was signifying that they were going to really double down on share buybacks, as they saw that as the most value accretive thing that they could do with capital. So it was that capital discipline that we really liked. And we've seen that play out through 22, 23, 24, 25, with the return on tangible equity improving very significantly. And also you'll see on the far right, which shows the earnings per share on the blue line versus the share price on the yellow line. So we've also had continuous upgrades to earnings per share, boosted by share buybacks and also organic beats on expectations, which has meant, if you see in the middle, the valuation hasn't really had to get to a level that has ever been particularly stretched. And so we still see that opportunity in UniCredit today. Again, one where expectations remain low because nobody has ever got too confident on European banks, and where we're starting to see the story roll out now into loan growth, but still with share buybacks and valuation support behind it. And then on the other end of the spectrum, we have ABB, less controversial in terms of its quality, and maybe more the debate is around valuation for this one. So this is a Swiss industrial leading the way in electrification and automation. And if I start by looking at the chart in the middle, actually, about the valuation. So the blue chart shows the PE over time. So we've kind of gone from mid to high teens level in the earlier part of the past 10 years, now towards 22 times plus. And so on the face of that, that would look too expensive for us to buy. But what is important to understand is the backing for that. So the management team have made a specific focus to a strategic decision to focus on higher return and more structurally high growth areas of the business. That's seen the ROIC improve from about 10% to 20% today. We've also seen in the middle chart how organic growth has increased from 1 to being 9% over the past few years. Now that 9% won't continue, but there's still been a structural increase in both the quality of the business and the more mid-term organic growth of probably more like mid-single digit. And again, looking on the far side, how that's been supported with earnings per share upgrades driving the share price higher. So if we move on to results, and ultimately that is where you will probably all be making your decisions on. I think I showed you that chart on slide 2, which showed consistent outperformance through different market environments. I think it's also important where that performance is being generated by. And so rather than going into the nuances of all the stocks here, I would just pick out some kind of big themes for us. And the first is, if we look at the chart on the left-hand side, which shows the attribution that can be, or the performance that can be attributed to different sectors relative to the benchmark. And our yellow bars show what's coming from our stock selection within sectors, and the blue bar is coming from what's coming from our allocation to that sector. And so you'll see, the focus we want to see in these charts is that most of it is coming from stock selection. So it hasn't come from taking big sector risks within our portfolio. The only place where we don't see that over the past 12 months has been in banks, for example, which is a relatively homogeneous sector, and in a year where they've all done very well, it's more been our overweight to the sector which has led that performance. But again, stock selection has been positive. And I think the other important things to point out is they're very different sectors: materials, pharma, banks, healthcare equipment. These are different places that we are looking to generate alpha from. It doesn't signify that we've taken a very big cyclical lean or defensive lean. And finally, it's about controlling the downside, because that's important for relative performance. So it's really comforting for us to see that, our worst sector was contributing less than 40 basis points drag, but yet we've got 3 sectors that are contributing more than 1% in relative outperformance. And then on the right-hand side, again, not to dwell on names, but what we're looking for is stocks with very different drivers, stocks that are doing well. Of course, the macro will matter to what stocks appear on this list, but we want them to have still been driven by idiosyncratic factors as well. And I think we see that in our top 5 with 4 different sectors represented, and often that's 5 different sectors. It's just that banks have been such a strong performing sector this year, ranging from a construction company like Heidelberg Materials with cement and aggregates, benefiting from US infrastructure and cost control and pricing power, to Engie, which is a real turnaround story where management credibility has been rebuilt over the past number of years. So more importantly, I think for all of you, is looking ahead to what we see in the market. And I think the first place for us to turn, and I think it's most of the questions we receive when it comes to European equities, is the changing nature of fiscal policy in Europe. And I think what's really important for us to recognize is just how important the decision on the debt brake by Germany was, because, and I'm afraid I think we might be losing, or at least in my chart, we're losing the dotted lines which show the forecast. But essentially, for all the noise that you hear about, maybe be France or other countries within Europe about, whether or not there is fiscal headroom, it's clear that the country within Europe, the most dominant economy with the biggest potential to change the trajectory for Europe, is also the one that has the broadest shoulders to carry that. And because they have debt to GDP still in the 60s, it brings the whole Eurozone average down to being mid-80s levels versus, for example, the US at 120% plus. And we are already seeing signs of how, if you look at the bars on the right-hand side, is how that government investment is starting to feed through into the economy. And we think that's going to continue to be the case for a number of years, and that's going to help to compress the growth premium that the US has had over the Eurozone for the past number of years. And we believe this is a structural medium-term trend. Often when it comes to stimulus, these can become, policies that go straight into consumers' pocket and they go out and spend it straight away. That isn't the case in Europe. This is about infrastructure. It's about competitive reform, understanding Europe's, how Europe is losing ground in the global race. And we think that that is going to be a big fill-up for European companies over the next 5 to 10 years. Next, I think it's also worth pointing out the consumer balance sheets. So here you'll see, if we focus the attention on the blue and green lines, which show European and UK savings rates relative to their average pre-COVID, essentially. And you compare that to, for example, the US. And I think the big stark difference we see happens around the Russian invasion of Ukraine. So just as we came out of lockdowns and the rest of the world, the US and in other regions, got out spending again, the sort of revenge spend as it was called, we had this cost inflation, energy price spike that happened in Europe that meant that we were all a little bit withheld. We see that, notwithstanding what's happened in the past couple of weeks, which I'm sure we'll turn to in the Q&A, but notwithstanding that, with rates coming down and with just the potential for this relief, maybe it's not in the next 6 months, but certainly over the next over the years to come, that leaves the consumer balance sheet in a much better position in Europe than it is in other regions. And we're already seeing signs of that, you know, on the right-hand side with retail sales and consumer confidence. And again, we know that these macro events can impact that on the short term, but the starting point for Europe is better and we think in a good position from here. And then finally, from a macro standpoint, again, we are already seeing, and the problem Europe has had, I think, over the past couple of years is there's always been something, whether it be tariffs, whether it be the current current action in Iran and the oil price spike, that kind of moves the narrative away. But what's comforting for us is the underlying performance in Europe continues to be strong. And so we're seeing that in PMIs, you know, service side has been resilient for quite a while now. Manufacturing side has been improving quite consistently. We look, for example, at the City Economic Surprise Index, which is showing how, you know, macro data coming out of Europe is surprising to the upside and has done that a lot over the past 2 years. And again, we are seeing signs of that. We are hearing that from the companies that we invest in. So again, this doesn't mean that this can't be postponed by 3 months or 6 months, but the starting position for Europe and the fundamental underlying drivers, we believe, are still positive. And lastly, if we turn to valuations, both on the left-hand side, where I think this shows us versus our long-term history, we are around average in Europe, which I think is a good starting point. But I think more on a good starting point given what we think about earnings growth kind of accelerating in Europe versus what it's done in the past. But I think also if you look on the right-hand side, and what this shows is the bars show MSCI Europe ex-UK's relative valuation discount versus the US. So it shows in all but 2 sectors, Europe has traded at a discount to the US, in fact, by more than 10% over the past 25 or 30 years. I can't remember exactly how long this is run for, but over the long term. The green arrows show where we are today. So in all but 2 sectors, we are at a wider discount, and at a market level, we're at an almost 30% discount versus that long run average of just over 10%. And so again, thinking about that story of the fiscal stimulus in Europe and how we believe that that's leading to a closer convergence of Europe to the US, I don't think we need to argue for Europe to trade at a premium to the US, but rather that discount narrows to still be a boost for European valuations going forward. And so finally, where does that leave us on positioning? And I think it's important, having said what we have about, you know, we are balanced and diversified portfolio with stock ideas coming from all sorts of places. And that is structurally how this portfolio will always be positioned. And so if you look at it at a sector level, it can be, you know, hard to interpret. You know, on the one hand, we are very overweight pharma, biotech, or at least, you know, that is our largest overweight. Whereas on the other hand, some of the more other areas of defensive, like household and personal products, or in healthcare equipment, we are underweight. And so it's about balancing that opportunity as we see it. Similarly, commercial and professional services. This includes a number of European industrial services names, kind of domestically focused names like SPIE and Bilfinger, which we think are focused to that fiscal swing in Europe, but we'll also have idiosyncratic and structural growth drivers behind energy transition, behind pricing power because of a labor supply shortage in that market. We're still overweight banks, as mentioned on UniCredit, and I think this is true for a lot of the sector. We're seeing still capital discipline, still strong valuations, and we are now seeing a return to loan growth in the region, both at the private level and to fund some of this competitive enhancement that needs to happen in Europe over the next decade. But on the other side, we're underweight financial services, and this includes some of the large private equity firms, for example, Partners Group and others, where we think valuations are still not attractive, and we are, the NAVs of those businesses are still to be questioned. So putting that together, we end up with a portfolio with a beta slightly above 1, kind of reflecting the gearing and our optimism on that European recovery. A diversified group in terms of the number of holdings, but one that, as you see from the alpha performance, we still think can generate lots of alpha just from lots of different ways. So we don't think of this as being, diversified to lower our conviction. Quite the opposite. It's diversified so that we can have even higher conviction in where we know we can add value, which is in the stock selection, and diversifying away some of that macro risk. And here you'll see on the style characteristics what I promised earlier. This is just looking at some metrics, but it's a good benchmark where our valuation below the market, our quality, if we looked at it on a ROIC basis, being more attractive, and a higher level and a better momentum in terms of earnings revisions. And so finally, before I hand back to Alan for the Q&A, I'll just leave you with those kind of the bits that we started on, which is, what do we think JEGI offers to investors? We think it's a core, balanced way of getting exposure to a European market which still has attractive valuations and has great earning growth potential. We think it's a differentiated investment process that's proved to generate alpha through different market conditions and has done so consistently over the last number of years. And finally, it's that attractive yield. So we call it having your cake and eating it too. It's that you have that yield without us having to compromise on our stock selection. So I'll pause there and hand back to you, Alan, for any questions that people have.
Thanks for that really thorough run through. As we were talking about before we started, the chances of being asked about energy prices seemed quite high, and indeed we do have some questions about that. So I think maybe not to try and put you on the spot about what happens in the next week or month, but what might be useful to look at is obviously Europe and the world more generally had an energy price spike not very long ago in 2022, and so there may be some lessons as investors that we can learn from that, and also perhaps Europe has made some fairly significant changes to its energy mix as well that might mean that this time may play out a little bit differently. So do you want to reflect on the experience of last time and see if we can come to any conclusions about how this time might be different?
Yeah.
The most fatal words in investment this time is different, but let's try.
Yeah, and I'm probably going to get the attribution of this quote wrong. I can't remember, but the there's that other side of that the more fatal quote is the time is never different, right? So we have to be open to both situations, and I think that's exactly right. Firstly, you're exactly right that I absolutely do not know what's going to happen next week or next month. And thankfully, the way we manage this portfolio is to try to be balanced throughout that so we don't have to spend much time thinking about it. Now, obviously we do, and it can create opportunities, but we also don't want to be jumping on opportunities on a day-by-day basis because we don't know, in what direction this goes, certainly for the interim period. I think what we're seeing from the markets at the moment is that people aren't expecting a long-term energy price shock, because I think if you look, for example, at the backwardation that we see in energy markets, if you look 12-month forward versus 1 month forward, you'll see a different picture of what the expectation of a resolution is. And so I think firstly that's important for us not to get too negative on where gas and energy prices might end up. But importantly, as you say, we have already had a playbook. And I think that's been important for Europe because there was real panic around it last time. This was a situation that we weren't prepared for. And it's not to say that we're perfectly prepared for it now, but both with LNG supply and also the reaction function, we now understand how consumers and industrials will change their behavior to reduce energy consumption, when needed. And if we go back to that savings point that I've heard, is we're already there. We don't need savings to, it's not like we think the consumer will save even more in this environment. Rather, it might delay what we think to be an opening up story in Europe.
Yeah, as you say, it's tough to really know what's going to happen in the next few weeks. But there's a question here which is about investing. I mean, the question specifically is about investing in emerging Europe, but I think maybe we can wrap into that. If you could talk a little bit about your off-benchmark investments, because I don't think you do directly invest in companies listed on emerging markets, but first of all, you do have a exposure to smaller mid caps, don't you? And companies from some of those European countries list in Amsterdam, for example, don't they? So there was an IPO this year from a Czech company. I don't know if you took shares in that, but there are opportunities to get exposure to different parts of Europe, aren't there? Even staying within developed markets. Do you want to just expand a little bit about that? Because obviously, as a core product, it's quite an important thing to understand that there is more than just the benchmark about JEGI.
Yes, I think that's right, and it's a place where we can really utilize that investment trust structure, I think, to invest in some of the smaller areas of the market, because we don't have those same liquidity thresholds. So that's, you're completely right. We don't directly invest in emerging Europe because we're solely focused on developed Europe, but there are certainly areas of the market where, whether it be banks that are, an Austrian bank that also has exposure to areas of Eastern Europe, or construction companies that, would be well positioned. For example, a theme is, if we see a recovery from the Ukraine, which are the businesses that benefit the most from that? And we will always be looking at that within our scenario analysis, which I spoke about, to understand which are the best players. And I think, that's where you would speak to when I met Kingspan recently, it was, of course, we have zero exposure to Ukraine today because nobody's building in the Ukraine, but we have facilities in Poland that, were something to change, our exposure changes quite significantly. And so then, as you mentioned, the off benchmark, we think that's been that's been a very strong performer for us over the past probably 18 months or so. I think that's we will always have 5 or 6%, I think, coming from small caps, because there's just lots of idiosyncratic opportunities. We sit beside our small cap team, who are meeting with these companies all the time and sharing that information with us, and we have those quantitative tools that are showing us that. But today you'll see our off benchmark allocation is about 13%. And off benchmark for us means small cap, basically, because we don't go outside of Europe in how we invest. And that's because we're seeing lots of domestically focused names in lots of different places, whether that be Kone Cranes, which is a lifting equipment business, like a cranes business, or Cairn Homes, which is a home builder in Ireland, or Spee and Bilfinger, which I mentioned, industrial services businesses in Germany. So a lot of companies that are more focused on that improving domestic Europe story, who avoid some of the tariff concerns, the geopolitical issues, and that's where I think we're seeing a lot of interest in small cap.
Yeah, thanks, Tim. And there's a two-part question on AI. First of all, you mentioned within your investment process that you use data analytics and AI to help you sift through things. And there's a specific question about that. If you could talk about the human and the machine element of that, and then I suppose the stock market itself is trying to sort through which businesses will be winners and which will be losers. And there's been a lot of share price movements in European equities recently as investors try to assess that. And perhaps if you could give some comments on where you are on all of that as well.
Yeah, great. I think, as you say, two quite distinct things. So if we think about it first in the investment process, I think what we have been really fortunate with is this has been embedded within our kind of quantitative research team for a very long time now. And they are obviously benefit from the budget and the resources that JPMorgan have, because often these AI tools are as useful for somebody deciding on mortgages in Missouri as they are for us. So it's those same tools and that big scale advantages that allows us to piggyback on that. And I think but it's very much been an evolution rather than a revolution in terms of how we are bringing that into our process. And that goes back maybe 10 years in terms of machine learning, and people's definition of what is AI depends on whether you want to get your valuation up by saying it's AI or not. But I think we've already been bringing that in terms of understanding. As an example, we talked about looking through more enhanced momentum signals. And so where can we find canary in the coal mine coming out of different sectors with stocks that have similar correlations that we haven't looked at before? Can we pull out interesting tidbits that are coming out from a call transcript from a completely different company, which allows us to take a different view and be kind of ahead of those earning changes for another company? And so I think that's where we're seeing it, and then in our investment processes, all of these things, using these tools are freeing up our time to do more research on it. But I would clarify, none of the decisions, nothing that goes into the portfolio happens because computer said yes or computer said no, right? Fundamentally, this is allowing us to screen ideas, and then we're going and doing the work. And then on the other side, it's a really interesting part of the market at the moment to find those opportunities. And I think why it's been so volatile has been these were coming off very high valuations. A lot of data and information businesses who are talking about using AI tools to boost growth in the coming years, and who typically were seen as very defensive businesses with recurring revenue streams, subscriptions, so like a low cost of equity essentially. And AI challengers have basically made everybody rethink that cost of equity, because if you're investing for duration in these businesses, if a competitor can come along and really eat into that share in a 5-year or 10-year time frame, the valuation still might not be cheap. And I have to be careful within how much I talk about current trading, but I would just say that we're always very open to understanding valuation opportunities as well as long-term structural themes.
And it's a very very live
Exactly, it's
debate,
very
isn't it?
And things change, and
Yeah. We are going to do the the Novo Nordisk question at the end, but
don't save it to the end. Let's get it.
but I just wanted to give you the chance just to talk a little bit about you're a European equity fund manager. It's your job to invest in Europe. Lots of global fund managers have been rediscovering, shall we say, or taking a fresh look at Europe, and you can see that in industry flows. Do you want to, without delving into the US versus Europe geopolitical thing, do you want to just run through some of the reasons why, when investors have taken a look at Europe, they have decided, yes, I'd like to increase my allocation? There's the German government's various spending plans and some of the, I know you went through some of the positive signals, but you just want to expand a little bit on that. Why, essentially, why would a global investor in the last year be more interested in Europe, and why would they stay now?
Yeah, I think, as you say, it's usually all of these things usually have a combination, myriad reasons, and one is, positioning. I think a lot of global investors, both with the strength of the US, found themselves leaning, having gone maybe overweight a global universe which was already moving towards the US. And so the diversification that they really believed they had in their global universe was becoming increasingly US, and there was dollar risk to that too. And I think that was maybe the start of it. And usually you need a catalyst to change what was already a valuation story. So, as I pointed out, that, we spent a lot of years talking about Europe starting to look cheaper, but without the catalyst for that to change, that doesn't necessarily play out. And so I think that it was at that point when we did start to see the improvement in domestic Europe, and people then looked again at the valuations of some of these stocks which on a comparable basis. Even today, if you looked at European banks versus US banks, we would still see a huge valuation signal. And as I showed with at a sector neutral level, we still see that. I think that is where we're getting that flow, and that takes time, especially from an institutional side, because that's where they start talking about their asset allocation. They start deciding on those things, but it builds up over a very long time. And nothing we see changes that view of the macro either, that Europe, if anything, is going to compress that growth differential to the US, and we'll continue to see flows coming into Europe is a belief of ours.
Mm-hmm. And as I said, that we can talk about Novo, but I think more generally, it's that sector is a sector in which Europe is stands shoulder to shoulder with other regions and countries. So, it's a center of excellence for pharmaceuticals, but the sector share prices haven't performed well, and Novo's obviously had some company specific challenges and some wider challenges. How have you been navigating Novo, and more generally, what's your view on the opportunity in the pharma companies?
Yeah, so we are underweight Novo, but as you see here, overweight pharma, biotech, life sciences, so the wider group of it, which has a combination of pharma names, but also there are diversified biotechs other biotechs like UCB and Argenx, or stocks that are more in like Lonza, which do contract manufacturing, benefiting from the change in production facilities that needs to happen around some of these tariff concerns. We've been, and as you say, I think, we firmly believe there are a lot of sectors that stand shoulder to shoulder with the rest of the world. And, sometimes it can take a while for that to believe. Like, for example, banks, we're not seeing the same credit concerns that we're seeing in other parts of the market in European banks, and having been so heavily regulated, they're in a really strong position. So, but I think you're right on pharma. And so that valuation opportunity is still there. It's always difficult because you're in a constant race to reinvent your pipeline at the same time that you come towards the end of patent expiries and what that does then for earnings going forward. So there is, you know, we have to be cognizant of that within valuations, but we still see lots of opportunity there. And Novo's been a tough, you know, it's one that we, you know, have net generated alpha from, because we did well from it on the way up. We didn't sell it exactly on the way down, but we got out of it early enough to still benefit, you know, overall. And I think you still need to remain balanced on some of these names, in that they continue to disappoint on CagriSema and the REDEFINE trials, but they're continuing to disappoint on the same thing, which is that we, you know, now we need to start looking at CagriSema as if there's little value behind it. But where we are seeing some progress is in the pill form of Wegovy, and also in some of their more sales practices. So they announced this deal with Hims earlier this week. So there are some signs of progress, but it's clear that the big failure for them came around CagriSema.
Thanks, that's great, and thanks for patiently answering all of those questions. My team will be very pleased that I'm going to bring this in only 2 minutes over time. Thanks so much to you. Thanks to everyone who's attended. As ever, the JPMorgan European Growth and Income team probably spend more time than they ought to writing their managers' reports in their annual report. I would always recommend reading those and have a look at their website. And of course, you can visit the Kepler website for information about JEGI and many other things as well. If there are any questions that we haven't managed to answer, do email us. And this presentation has been recorded, will be available to watch again, and the slides will be available to download as well. So thanks to you, Tim, and thanks to everyone. And we'll see you on the next one.
Thanks very much, everyone.